Over half the traffic flowing across Cloudflare's network right now isn't even human. It's August 6th, 2026, and welcome to Earnings Unscripted. Today we're looking at Cloudflare's second quarter, ticker NET, which basically argues that machines just conquered the internet.
Yeah, that's definitely one way to frame an earnings call. I mean, they painted a picture where the ad-supported web we've known is essentially obsolete.
Exactly. Okay, so before we talk robots, let's anchor the math. Revenue landed around $696 million, up 36% year over year. And profits comfortably beat expectations too, but the GAAP operating line widened into a pretty steep loss.
Right, except that widened loss isn't an execution failure. It's a strategic teardown. They slashed headcount by 20% back in May to align with this new AI-first model. You pull out that severance cost, and Matthew Prentz pointed out they were in striking distance of genuine GAAP profitability.
Which completely explains why Wall Street didn't panic. The regular trading session was choppy, but right after these numbers dropped, the stock gapped up hard and blasted past $330 a share. And since we're watching the tape go a bit crazy, I should probably mention our takes here are strictly personal opinions. Definitely not financial advice for your portfolio.
Good call. Because the market reaction is pricing in some fairly aggressive assumptions. They're telling investors they don't even need to fight the big hyperscalers for standard workloads. In fact, they're openly refusing to stockpile commodity compute like everybody else.
Wait, so if they aren't hoarding generic hardware to rent out, how are they handling all this non-human traffic?
It's all about edge deployment. They claim they can squeeze out 10 times the utilization per dollar by strictly controlling inference at the edge of the network rather than just renting basic server time.
Okay, so efficiency over brute force. And it's apparently winning over clients. There is that story about a generative AI company signing a massive zero egress deal specifically to escape typical cloud provider taxes.
Exactly. The product pull is real, but they're financing all this by changing how customers actually buy. They're moving away from predictable software subscriptions and pushing people towards these consumption-style drawdowns.
Right. And I need to hear how that new pool of funds contract actually functions in the wild because their own CFO warned it makes projecting their trajectory way harder.
That unpredictability comes directly from how they're letting customers pay now. Instead of a standard software subscription where you bill a predictable flat fee every month, the customer commits a lump sum up front. They call it a pool of funds.
So it's essentially a prepaid gift card for enterprise software? They load up a balance and just swipe it every time they spin up a server?
Not quite that simple. The budget is locked in, but they're pulling down varying resources across compute, storage, or security at whatever ratio they need that day. Thomas Seifert specifically flagged this. He said, "We are moving away from a purely ratable SaaS model towards a much more diversified mix of pool of funds, consumption-based structures, and also what we call T-shirt sizing."
Okay, wait. T-shirt sizing?
Yeah, bundling capacities into broad categories so clients don't get nickel and dimed on individual bytes. But the headache for analysts modeling this is that customers burn through these packages at totally unpredictable rates. It creates stacking behavior. One quarter, they sip the network capacity. The next quarter, they chug it. So your sequential forecast gets wildly lumpy.
Which completely explains why guidance felt a little conservative, even with that net retention rate bouncing back up to 120%.
Exactly. That retention metric is fantastic because it proves organic upselling is working. But if you connect the dots, this whole pricing overhaul ties directly back to your robots conquering the internet point.
Right, because autonomous traffic probably consumes resources very differently than a human clicking on a website.
Different consumption and the completely destroyed monetization model. Matthew Prentz had this incredible line about how the business model of the internet for the last 27 years was defined by advertising, but the next 27 is going to be very different. Bots don't look at banner ads.
Which means you can't monetize human attention anymore. You have to monetize the actual machine workflow.
You hit the nail on the head. That's why they rolled out, well, they're calling it the monetization gateway. That and these new wallets. It's a structural payment system built directly into Cloudflare's network, designed to handle up to 100 million fraction of a penny microtransactions per second.
It's just wild. They're basically building a shadow economy for bots.
Well, they have to. The barrier to entry for creating these agents is practically zero now. Prince even shared an anecdote about his executive assistant writing code with AI to automate things around her house. She just deployed her apps right onto Cloudflare's serverless edge. No technical degree required.
Which bypasses the legacy public clouds entirely.
Absolutely, and that's the strategic wedge here. They're winning deals by explicitly refusing to play the commodity hardware game. There's a great detail in the transcript about a fast-growing generative AI client signing a new $7.5 million contract purely to avoid standard cloud provider fees.
Oh, right, because normally when you pull huge volumes of data out of a hyperscaler to run inferences, you get slammed with exit taxes.
Massive exit taxes. It destroys the unit economics for an AI startup. By pushing those workloads to Cloudflare's network, where exit fees essentially vanish, the customer stays hardware independent and saves their capital.
Okay, but supporting millions of these little autonomous agents running around the edge takes serious physical infrastructure. And I'm looking at their capital expenditures for the quarter. CapEx actually fell sequentially to just 7% of revenue.
Only temporarily. The full-year guide warns that CapEx will step up to somewhere between 14 and 15% of annual revenue. So that quiet second quarter was really just the calm before the storm.
So they essentially need to double their infrastructure burn over the next 6 months just to host a machine economy they're still figuring out how to price?
Exactly. They're betting that if they build the perfect robot highway now, the pricing model will just sort itself out over time. But that takes serious nerve when you've got to start writing those chunky CapEx checks in the second half of the year.
Which brings us to what management is actually promising from here, right? Because they still have to convince Wall Street this isn't just a very expensive science project. How confident are they sounding about the rest of 2026?
Oh, they're leaning all the way in. For the third quarter, Thomas Seifert guided revenue somewhere between 736 and 737 million. That implies growth stays steady at roughly 31%.
Okay, so the growth engine isn't stalling out while they remodel the house. That's a huge relief for investors. Did they bump the full-year target too?
Yeah, they expect the full year to land around $2.87 billion, but Seifert explicitly added a warning label. Because they're shifting to those pool of funds contracts, forecasting, the exact quarter-to-quarter momentum gets noticeably harder.
Right, the whole T-shirt sizing thing, laughing softly. If customers draw down their balance all at once, you get a massive quarter, and if they take their time, well, you look like you're missing estimates.
Exactly. So next quarter, I'm watching two things. One, how unpredictable does that revenue recognition actually get? And two, can they prove this agent traffic is generating durable cash, not just vanity volume?
Because if they're right, they essentially own the infrastructure for the next era of the internet.
And if they're wrong, they just bought a whole lot of network capacity for a bunch of bots that don't pay their bills.
Okay, well, that's a beautifully cynical way to summarize the whole situation. Fascinating vision, massive execution risk. We'll be waiting on the edge of our seats for the next update.
Catch you later.
Before we log off, if you want to keep catching these quick deep dives, just tap the follow button in your podcast app. And speaking of bots running the internet, this entire show is completely generated by AI, from the script down to our synthetic voices, getting the analysis from Cloudflare's call to your feed the exact same day. We always love hearing from you, so send your feedback or ticker requests over to earningsunscripted@datamadness.ca.
Catch you later.